Our exceptional first quarter results are a testament to the strength of our brands, said Andrew Rees, Chief Executive Officer of Crocs. He continued with, "We are raising our 2023 revenue growth outlook to now be 11% to 14%, resulting in revenue of approximately $4 billion, reflecting our confidence in our ability to continue to gain market share, deliver best-in-class profitability, and generate strong cash flow." So let's take a look at these exceptional results that they just published. Revenue is up by 33.9% year over year. Net income is up 105.5% year over year. Cash went down by 34.4% in the last quarter, but the long-term debt also went down by 2.1% in the same time period. And when we look a little bit deeper, we see that both brands, Crocs and recently acquired Hey Dude, are growing really nicely. Okay, so the recent results are solid, but as value investors, we have to make decisions based on the long-term performance of the company and not the short-term events. So let's analyze and value Crocs to find out, is it a good investment opportunity at a current time? Individual insiders, that is a check with 2.7% of the company owned by individual insiders. And we like to see this number over 2%. Because if the management owns a lot of shares, then we can be pretty sure that they will take good care of the shareholders. And are they buying right now? That is an X. In the last year, we see that individual insiders bought 20,600 shares and at the same time sold almost 97,000 shares. And do super investors own this company? That is a check. We see only one super investor, Bill Miller, owning shares of Crocs. And is he buying right now? That is an X. He sold 2,000 shares in Q4 2022. Return on invested capital. That is an X at 9.2% 10-year median returns. And we want to see this number higher than 10%. So it is pretty close, but not close enough. And free cash flow growth? That is a check at 18.6% 10-year compound annual growth rate. And just as with return on invested capital, we like to see this number higher than 10%. So that is a very satisfying result. And what do we know about net profit margin? It is also a check at 16.3%, and the industry average is 11.2%. So just as the CEO Andrew Rees said, they are delivering best-in-class profitability. That is something really worth noting. And now let's take a look at share buyback. It is a check. In the last 10 years, they bought back 30.3% of their shares. That is absolutely great news for long-term investors. We don't have to put any extra money into this investment, and still we are owning a bigger portion of the company. And how is the debt looking? It is an X. It would take Crocs almost 4 years to pay the long-term debt with a current free cash flow. And they have such debt because they needed money to buy Hey Dude brands. So as long as Hey Dude will grow and generate money, they will slowly pay down this debt, just like they are doing right now. To value Crocs, we will have to estimate its growth for the next 10 years, and we will create 3 scenarios: low, medium, and a high one. So in the low scenario, we will estimate a growth of 7% for the entire 10 years. In the medium, 10% for the first 5 years, and then 12%, and in the high scenario, 13%, and then 15%. And why did I choose such estimates? Well, if we look at the last 10 years, we see that the revenue grew annually by 12.2%, free cash flow by 18.6%, and earnings per share by 19.7%. So our estimates seem really conservative, and that is exactly the way we want them to be. So with such estimates, the intrinsic value in the low scenario is $134, in the medium $189, and in the high scenario $244. But of course, we have to add a margin of safety to those prices. That way, we are building a buffer for our investment. We are creating a space in which we can make mistakes and still not get destroyed financially. I use a 30% margin of safety. And with such a margin, we get, in the low scenario, $94, in the medium, $132, and in the high one, $170. And the current price is around $109. So only the low scenario with the margin of safety is red. Everything else is in the green. That is very good news indeed. Crocs seems to be a very strong company with good growth, great margins, and a slight problem with debt, but hopefully it is under control. And because of the recent decline on the stock market, it is also available for a very reasonable price. So tell me, what do you think? Am I too optimistic? Am I missing something important in this valuation? Or is it really a very interesting investment opportunity?